Hello everyone, welcome back to the XRP HBAR channel. If you hold XRP or HBAR and you don't know what's coming, you're among the 99% of people who might get shaken out in 2026. And in this video, I'm going to show you exactly what to avoid so you don't get shaken out for either one. Okay, so before I get into any of the actual data, I got to clear something up right away, because I think this is the single most misunderstood thing in this entire conversation. And getting it wrong is exactly how people panic about the wrong risk while ignoring the real one. There are actually two completely different kinds of getting shaken out. And most content treats them like they're the same thing when they're really not. And this applies to both of these coins, just in slightly different ways. For each, the first kind is mechanical. It's leveraged traders, people trading XRP or HBAR with borrowed money, futures, perpetual contracts, getting forcibly liquidated when the price moves against them. That's an actual technical event. The exchange itself closes your position because your margin can't cover the loss anymore. It's not a choice. It's not emotional. It's just math catching up to leverage. The second kind is behavioral. It's spot holders, people who just own the actual coin, no leverage, no borrowed money, panicking and selling during a scary price move, even though technically nothing forced them to. Nobody liquidated them. They liquidated themselves emotionally in the moment. And here's why that distinction matters so much. For this video, specifically, if you're a pure spot holder with zero leverage, you literally cannot be mechanically liquidated on either coin. It's not possible. The worst thing that can happen to you is your position is worth less on paper, which is completely recoverable as long as you don't sell. The shakeout risk for you is entirely behavioral. It's about whether you panic, not whether some external force can reach into your wallet and take your coins. For leverage traders, it's a completely different, much more mechanical kind of risk. And I want to walk through both for both coins properly, because understanding the mechanism is the entire key to not becoming a casualty of it. Let's start with the mechanical side, because there's real recent documented data for both XRP and HBAR that shows exactly how this works. And honestly, the two markets look pretty different from each other once you actually dig in. XRP first, back in October 2025. XRP went through what Glassnode, the on-chain data firm, called a major deleveraging event. XRP, perpetual futures, open interest. The total value of outstanding leveraged positions still open in the market. 3.5% fell from 7 billion XRP down to 2 billion XRP, a 71% drop in the middle of a price crash. Here's what that actually means in practice. A lot of traders were holding leveraged long positions, bets that the price would keep going up, using borrowed money to amplify their exposure. When the price started dropping, some of those positions hit their liquidation point. The exchange force closed them. Force closing, a leveraged long, means selling the underlying asset to close it out. That selling pushes the price down further, which then triggers the next layer of leveraged longs to hit their liquidation point, which causes more forced selling, which pushes the price down even more. That's a liquidation cascade, and it's the actual mechanical engine behind most sudden, violent crypto price crashes. By early 2026, the deleveraging didn't stop there. Open interest kept shrinking, dropping another 25% down to around $1.5 billion XRP, valued at about $2 billion. XRP went from around $2.90 in October down to around $1.40 by roughly March, with the price decline tracking almost exactly alongside the falling open interest. The signature of old leverage positions getting closed out rather than fresh bearish bets piling on. Now here's the part that flips the scary framing on its head a little bit. Lower open interest after a flush like that usually means less shakeout risk going forward, not more, because a cascade needs leveraged fuel sitting there ready to get triggered, and that fuel got wiped out. As of mid-June, XRP's open interest sat around $2.5 billion, down roughly 75% from its mid-2025 peak of around $10 billion. That's one of the sharpest derivatives deleveraging events in crypto history. And a similar reset back in April last year preceded a 103% rally over the following 3 months. I'm not telling you that's guaranteed to repeat. It isn't, but the structural cascade risk is genuinely lower than it was at last year's peak. There's also an interesting divergence underneath that. While total XRP open interest collapsed, CME's regulated institutional XRP futures actually hit a record $1.4 billion in early June, with 29 separate large institutional holders. So retail and crypto native leverage got flushed hard, while institutional money built exposure through a completely different through a completely different channel, more controlled, two very different groups, two very different behaviors inside the same overall data. Now, HBAR and the picture here is genuinely different in some important ways. HBR's current open interest sits somewhere around $130 to $140 million against a market cap of roughly $4 billion. That's a much smaller derivatives market in absolute terms, obviously. HBAR's whole market is smaller than XRP's. But here's the detail that I think is actually the most important comparative point in this entire video. On a typical day, HBAR's futures trading volume has been running somewhere around 4 to 10 times larger than its actual spot trading volume. One recent snapshot showed futures volume at $144 million against spot volume of just over $14 million. That's not a small gap. That's leveraged speculation completely dwarfing actual buying and selling of the real token. Compare that to XRP, where futures volume runs maybe 3 to 4 times spot volume on a typical day, and still leverage heavy, but nowhere near as lopsided as HBAR's ratio. So what that tells you is proportionally, HBAR's price action is being driven by leveraged bets to an even greater degree than XRP's is. Even though XRP's absolute dollar figures are much bigger, a smaller coin with a futures market that dwarfs its spot market, that badly is structurally more exposed to leverage-driven whipsaws than its market cap alone would suggest. And I think it's worth pausing on why that gap exists in the first place, because it's not random. HBR's spot market, the actual buying and selling of real tokens, simply hasn't grown as deep and as liquid as XRP's has over the years, partly because XRP has had a longer track record of institutional and exchange level adoption. Futures and perpetual contracts, on the other hand, are cheap and easy for any exchange to list, regardless of how deep the underlying spot liquidity actually is, because the exchange isn't required to hold the real asset, just to track the price. So you end up with a situation where the speculative leveraged layer of the market grows much faster than the actual ownership layer underneath it. And that mismatch is exactly the kind of structural setup that makes a thinner coin more vulnerable to leverage-driven whipsaws than its market cap alone would suggest. And there's a real recent example of this actually playing out. Back in January this year, multiple trackers flagged HBR's selling pressure as the highest it had been all year, with liquidation maps showing growing vulnerability, specifically among long traders clustered around the $1.11 to $1.12 support zone. If that support broke, the expected outcome was a cascade of long liquidations pushing the price down toward the next support level. That's the exact same mechanical pattern we just walked through for XRP, just playing out on a much smaller, more concentrated scale, where a smaller dollar amount of forced selling can move the price proportionally further because the whole market is thinner. Right now, HBR's long to short ratio on major exchanges sits around 1.7 to 1.1, meaning roughly 63% of leveraged positions are long, betting the price goes up against 37% short. That's a tilted, somewhat crowded setup. Not extreme, but worth watching, because it means there's currently more long-side leverage sitting in the market that could get liquidated in a cascade if the price moves down meaningfully compared to a more balanced 50-50th setup. And here's the leverage math for both coins, concretely, because I think this is the number that actually matters most. Regardless of which one you're holding, even a 5 times leveraged long can be fully wiped out by a 20% adverse price move. On XRP, 20% is a completely routine swing. It's happened repeatedly in both directions over the past few years. On HBAR, the swings have historically been even sharper percentage-wise, given the smaller market and thinner liquidity. So that same 5 times leverage is, if anything, even more dangerous to carry on HBAR than on XRP. If you're using leverage on either of these, you are voluntarily opting into the mechanical shakeout risk, the one driven by liquidation cascades, regardless of how solid your actual thesis about either coin might be. Okay, now let's get into the rich list side of this, the concentration data, because this connects to the second kind of shakeout, the behavioral kind, and the structure looks meaningfully different between these two coins. For XRP, the top 10 wallets on the ledger control somewhere around 18.5 to 20% of circulating supply. 7 of those top 10 belong to Ripple, mostly sitting in escrow. 55 billion XRP locked up back in 2017, released on a transparent program schedule, up to 1 billion XRP unlocking per month, with whatever's unused getting relocked rather than dumped. That's a predictable, rule-bound structure. There's also a broader, more current number worth knowing. Wallets holding 1 million XRP or more, a much wider whale tier, now control roughly 74.1% of circulating supply, according to Sentiment's tracking. And that figure's been growing. These large holders bought roughly 1.53 billion additional XRP over just the past 6 months. That's accumulation, not distribution. For HBAR, the picture at the very top is genuinely flatter. The single largest known whale wallet on the Hedera network holds somewhere around 3 billion HBAR, which, against a 50 billion total supply, is only about 6%. 6% in the biggest single wallet I could find data on, compared to XRP's 6 escrow wallets, each holding 5% apiece. Or, more dramatically, compared to a coin like XLM, where the single biggest wallet alone holds over 40%. There's also some community speculation that even HBAR's biggest wallet might be tied to an exchange, meaning pooled customer funds rather than one entity's personal stash, though I don't have full confirmation of that. Broader whale tier concentration on HBAR, a wider band of large addresses, has been estimated somewhere around 55% of total supply, a real number, but a fuzzier and less precisely published one than what's available for XRP specifically. There's also a regulated product layer worth mentioning for HBAR specifically, since it didn't really exist in the same form for XRP until more recently. The Canary HBAR ETF, a regulated exchange-listed product, now holds around 1.3% of total circulating HBAR, somewhere around 3.24 billion tokens, after pulling in over $93 million in cumulative net inflows. That's a genuinely new category of holders showing up in the rich list, a regulated fund rather than a private whale or a company treasury. And it's a category that's realistically only going to grow if more HBAR ETF filings get approved down the line. XRP has its own version of this too. XRP ETF inflows reached $1.44 billion in cumulative net subscriptions through the middle of this year, Even as Bitcoin ETFs were seeing multi-billion-dollar outflows over the same stretch, which tells you something about where at least some of the regulated, risk-managed institutional money has been rotating toward. So now let's actually run the math. Though what happens if the top 10 wallets start moving exercise for both coins using their actual current numbers? For XRP, market cap sits around $85 minus $86 billion, with daily spot volume around $700 million on a typical day. If the top 10 wallets, that 18-20% slice, somehow liquidated simultaneously, you're talking about something like $15, $17 billion worth of XRP hitting the market against $700 million in daily spot volume. That's roughly 20-25 days worth of normal spot volume trying to clear all at. Once that would crater the price short term, no question. But most of that top 10 is Ripple's scheduled escrow, which doesn't behave like a panicked seller. It behaves like a known, telegraphed release mechanism. The market's already pricing in. For HBAR, market cap sits around $4 billion, with daily spot volume running somewhere around $28 to $36 million on a typical day. If we apply that same broad 50 to 55% whale tier estimate, you're talking about roughly $2 billion worth of HBAR representing that cohort against $30 million or so in daily spot volume. That's something like 65 to 70 days worth of normal spot volume. 65 days, that's a dramatically bigger multiple than XRP's 20 to 25 days, purely because HBAR's actual spot market is so much thinner relative to the size of its concentrated holdings. But again, that whale tier isn't one entity with one finger on one trigger. It's a broad, diffuse group of independent holders, and the single biggest wallet specifically is only 6%, not 40, not 30, meaning there's no single phone call that could trigger that whole scenario the way a break from Ripple's established pattern theoretically could for XRP. So here's what to actually avoid concretely for both coins to make sure you're not the one who gets shaken out in whatever 2026 actually brings. First, avoid using meaningful leverage on either coin, or at minimum, understand clearly that a routine 20% move wipes out even modest 5x leverage, and that HBAR's thinner market makes that risk, if anything, sharper than it is on XRP. Second, avoid treating today's XRP open interest reset as a permanent guarantee of safety. It's genuinely lower risk right now than it was last year, but it's already showing early signs of rebuilding on at least one major exchange. Third, for HBAR specifically, keep an eye on that long to short ratio and the futures to spot volume gap, because a market where leverage so heavily dominates actual spot activity is more prone to sharp, leverage-driven moves than its overall size would suggest. Fourth, if you're a pure spot holder on either coin, avoid confusing someone else's liquidation cascade with your own actual risk. The price moving down hard because other people got liquidated doesn't liquidate you, only your own decision to sell does that. And fifth, have no actual plan at all for normal volatility on either asset. Because deciding in advance while you're calm what a 40 or 50% move actually means for your position removes the entire behavioral shakeout risk before it ever gets a chance to start. And if you actually want to put this into practice, rather than just nodding along, the concrete version looks like this. Pull up a free tracker like Cohen Glass for both coins. Once a week is plenty, and just glance at three numbers: open interest, the long to short ratio, and funding rates. You're not trying to become a professional derivatives trader. You're just trying to notice if either market is quietly getting more crowded on one side or the other, the kind of setup that tends to precede a sharper cascade when the price eventually does turn. That's maybe 5 minutes a week. And it's the difference between being surprised by a leverage-driven move and actually seeing the pressure building beforehand. So here's the honest synthesis. XRP's mechanical shakeout risk is currently lower than its mid-2025 peak thanks to a major deleveraging flush, but it's a market where leverage is rebuilding gradually and worth watching. HBR's mechanical shakeout risk is structurally different, a smaller absolute market, but one where leverage makes up a disproportionately large share of total trading activity relative to spot, which means the same percentage move can hit harder. On the concentration side, XRP's top 10 risk is mostly a transparent scheduled company escrow, while HBAR's top tier is flatter and more diffuse. With no single wallet anywhere near the size of XRP's biggest holders, but also less precisely documented overall, neither coin's concentration data points to an obvious imminent mass sell scenario. The trend on XRP's broader whale cohort has actually been accumulation, not distribution, over the past 6 months specifically. I think it's also worth being honest that none of this mechanical or concentration analysis tells you anything about whether either coin's underlying fundamental case is strong or weak. That's a completely separate question from the shakeout question this video is actually about. A coin can have a rock-solid long-term thesis and still go through a brutal leverage-driven liquidation cascade in the short term. And a coin can have a shaky thesis and still avoid a mechanical shakeout simply because there wasn't much leverage built up against it at the time. Mixing those two separate questions together, is the thesis good and is the market structure fragile right now, is exactly how people end up either panicking unnecessarily over a coin with strong fundamentals or staying falsely confident in a coin that's sitting on top of a genuinely crowded, fragile derivative setup. Keeping them separate in your head is honestly half the battle. 99% of people who get shaken out on either coin in either sense, mechanical or behavioral, are the ones who never actually understood which kind of risk they were even exposed to. In the first place, if walking through the actual mechanics for both of these, instead of just the scary headline version of Shakeout, is useful to you, go ahead and hit like on this one. It genuinely helps put this kind of honest, comparative breakdown in front of more people. Instead of pure fear content, subscribe if you want more of this, the actual derivatives and concentration data tracked properly across multiple coins. Instead of vague warnings with no numbers behind them, drop a comment and tell me honestly, between XRP and HBAR, which one's current setup actually concerns you more after seeing the real numbers? The bigger but currently deleveraged XRP market, or the smaller but more leverage-dominated HBAR market? And I want to see real reasoning, not just a gut reaction. And if you know somebody trading either of these with leverage without actually understanding how close a routine 20% move puts them to liquidation, send them this video before 2026. Test them that the hard way. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and share it with others. It really helps the channel grow. This is XRP HBAR signing off. Goodbye, and I'll see you in the next one.